It's not that there's no risk, but I would call it low risk, not no risk. When set up properly, it's not free, but it's low cost because you're not taking the money out of your pocket. You're just putting you're putting that collateral. You're clogging up the collateral.
When you need some advice, never sacrifice. Always get it right. Ask the Planman. Finance, insurance, and more.
Hi, everybody. Welcome to Ask the Planman. I'm your host, Bruce Weinstein, and I have a belief that everybody deserves their own levels of financial plan and financial security. I've been serving my clients since 1986, helping them achieve their financial goals and objectives, and we do it predominantly through planning. Today, I am pleased to be bringing you a conversation with Mel Lieber, a premium finance specialist. Mel is a financial whiz that eats numbers for breakfast, but he keeps kosher, so there's no bacon and eggs in that breakfast. Mel founded Finance Premiums in 2015 and quickly became a leader in the field. He was the youngest ever recipient of the NIW's Top Producer Award, one of the youngest qualifiers for the National Life Group's Conference of Champions, meaning he's writing a lot of scratch, folks. He's bringing in big cases and big deals. He's happily married, has 5 children, God bless, enjoys hiking, sports, and all sorts of outdoor activities. And today we're finding him broadcasting live from the promised land of Israel. So welcome to the show, Mel. I appreciate you joining us today. I really want to give the audience a deep dive conversation on what exactly is premium financing. Let's dig in there.
Okay, sure. Let's do it. Thank you, Bruce, for having me on. It's a pleasure. I feel like we're friends already, even though we just met a couple minutes ago.
We're mishpacha. Let's go.
Let's do it. Okay, so premium financing. Premium financing is it's a strategy to fill a financial need that somebody may have, a way of servicing for some people it's estate taxes, retirement planning. We'll get into the nitty gritty in a minute, but it's a way of solving a problem without opening your wallet as much as other problems. And what I mean by that is that for a lot of people who have good ways of earning income and their assets are working for them very well. For example, let's say they would need a large life insurance policy to pay for estate taxes. Instead of taking all that money out of their pocket, rather we're going to set up a lender, a bank will finance those premiums, sometimes 50%, sometimes 75%, sometimes 100% of those premiums. And then later on, we'll be able to take some money out of the policy, pay back the lender, and now this client will have a policy there to pay for his needs without spending as much money out of pocket, allowing his assets to work for him in a more effective way.
So at its core, we'll go back to the top. It's a life insurance strategy where you're actually getting a lender of some capacity to put up, thus the term premium financing. So we're financing the premiums for the insurance. So if John Q. Public is doing a deal and it's $1 million premium and they don't want to spend the $1 million, they can actually calculate and figure out a way to get the majority of that, as you said, 75% or higher financed. Yeah. So again, for the listener, so my listener simply is, this is a life insurance strategy. And then it's going to fall into 2 categories. We're going to break down, who or where this could be utilized, right? But in this, and at its core, it's life insurance structure, and then getting the ability to finance it. So, can you break down more how? We'll get into A and B. You said there's 2 different types of strategies for the different clientele, but
different types of folks.
Different types of folks. So. The strategy in of itself, like how does that work? Are they dealing with a bank? Are they dealing with a private lender? I know some of them will have things where they have to put up a pledge assets of some kind. So can you delve into a little bit more?
Sure, my pleasure. Also, just a way for some people to conceptualize this a little bit more. Somebody wants a house, right? They have a need, whether it's for investment purposes, they want that building, or for their personal residence, they want a house. Paying for it out of cash is sometimes not a very good option for people. But when you bring in a lender, you bring in a mortgage, your reach goes much, much further. So this is taking that same basic concept of leverage that we're all familiar and using it in a life insurance type world. And let me just explain how this works. So let's say we have a client who his financial advisor tells him, listen, Charlie, the way that it's looking, after, when you kick the bucket after 100, however old it's going to be,
120 years,
120, 120. So your family is going to owe $50 million in taxes. Because let's keep in mind, everybody, that there is a 40% federal estate tax on all assets above the exclusion. Currently, which will be around $17 million a person, $34 million for a couple. That number is actually officially set to go down in a couple of years. We'll have to wait and see to find out exactly what happens. And for anybody who's 50 years old, we definitely have no idea what that number is going to be in 40 years. Your guess is as good as mine, and it really is. So the financial advisor says you're going to owe $40 million, $50 million in taxes. So, you might be thinking, this guy's a wealthy guy. He's worth $130 million. They could afford $50 million in taxes. But the real truth is almost nobody could afford $50 million in estate taxes. Because usually they're going to own an asset, whether it's real estate, whether it's the family business, which a lot of times most of the money's in the family business. And if they have to come up with $50 million, that usually will mean they have to sell the business. They have to sell the real estate. It might be a bad time to sell. It's going to be a fire sale, etc. They need that money. So what are their options? Now, the basic option is to go buy life insurance, which is the most, it kicks in at the perfect time. It could grow out of somebody's estate and won't cause greater problems of future estate taxes. So to do that, depending obviously on age and health, it might be $2 million a year in premium. Now, just like most of, the people who aren't in such high net worth don't like paying $25,000 a year in premium. So the ultra high net worth, in a very similar way, don't like paying $2 million a year in premium. It's not fun. And therefore, what we do is we take a high performing life insurance policy, a type of life insurance policy that's able to grow on average 6, 7, 8, 9% a year. And what we do is we're going to have
on the cash value. On the cash value,
correct. On the cash value, correct. Well said. And what we're going to do is, instead of paying that out of pocket, we're going to pay, depending on age, health, etc. So let's say 90% of that will come from a lender. Sometimes 100% of that will come from the lender, and we'll pay the premiums. Now, what will be the collateral for that loan? So most of the collateral will be the policy itself, will be the actual collateral for that loan. In the earlier years, because the way that life insurance is structured is the fees are front loaded in the policies. So therefore it takes a little time for it to pick up steam and grow. Right. And therefore for those first, 10, 15, 17, 20 years, depending on the structure, in those earlier years, the policy will not be able to fully collateralize the loan. And therefore the client will have to put up some outside collateral. And 90% of the collateral will be the policy itself. 10% will be something else that the client will post. It will remain with his money manager, with his whatever it is, but that will be the collateral. And at the end of the day, 15, 20 years down the road, statistically, it's always worked when structured properly. I can't promise you the future, but I can tell you in the past, it's always worked, where you'll be able to take money out of the insurance policy, pay back the lender, and this guy is left with the policy. But don't be mistaken, it's not free money, because he was posting significant collateral for those years, which he could have done other things and made a lot more money with that. That money that he was putting down as collateral, he was putting it in, let's say, bonds or whatever, earning 3-4%. If he wanted to put that money in the stock market, he would have earned much more money. So there is an opportunity cost in that money, but it's usually in his favor anyways.
So that's a good question, because it's been my understanding in the cases that I've worked on and designed, they don't have to pledge such a conservative asset. Could they not pledge equity instead of bonds, or do they need to
So
be in something
it
more
depends.
conservative?
The industry used to.
If somebody has a building, can I pledge? If I own the RCA building, it's worth $50 million, and I have to pledge 20. Can I pledge the building, and that asset just stays where it is, and I've pledged it against the loan, or is that too illiquid?
That is a great question. And there are some people that will allow that type of pledge to come through. Okay. Personally, I do not advise to do such, and let me explain why. Part of the magic of premium finance is we need the growth of the policy to outperform the cost of the money by, we want at least a 1% spread between the growth of the policy above the cost of the money. It's arbitrage. That's the magic sauce. Sure. You gotta gain more than it costs you to borrow the money.
Right.
So
let me just break down a little bit, because maybe a piece here you're alluding to, but we didn't set up, is there's a pledge component, and then the borrower, the person who's getting the insurance, they're going to pay interest against that loan every year and service the interest separately. So there is some modest payments relative to the loan balance, as you're talking about. And that's where you're alluding to the spread, because if they're borrowing at 7 and they could make 8, the policy's still growing. And
so I would actually just make a little jump in on there on that.
Yeah, go ahead.
It kind of depends on age. Usually by a client who's healthy and under 53, 54 or so, I will usually not make that client pay the interest, and I would roll that interest and let that interest compound. I don't really care, because my growth is more. Once we get to older than that or younger than that, but not as healthy, so then I'm going to want the client to pay some interest.
Gotcha. Okay. So it's not a mandate. It's going to depend on the design and the structure of it. The one I did was looking for some payments along the way for the interest to keep it. I mean, it was also like a $20 million loan, so there's pretty high interest. So
for sure.
It's all relative.
So,
right?
So the idea is that I want to get money for as cheap as possible. I want to get really, really cheap money. So how do I get really cheap money? Well, the bank is going to give really cheap money when it's able to lend a lot of money at once, that we got. And if it's able to have very low risk. What's very low risk? Very low risk is when you have a solid collateral. Now, the policy itself is actually a better collateral than real estate, because the policy itself is what we call, it's like a cash collateral. You could call the bank, you could call that collateral in, you could turn that policy into cash in a couple of days. So therefore, it's a cash collateral. And real estate, as we know, real estate goes up 95% of the time. But that's why it makes it a very good collateral. But 5% of the time, it goes down, which overall makes it a very good asset. But it does go down 5% of the time. This type of insurance policy that we use is going to be guaranteed, not outside of the fees, but the actual, from a growth standpoint in the policy, it's never going to go down outside of fees. Therefore, it doesn't even have the risk of going down 5% of the time. Therefore, the banks view it as a cash collateral, and therefore they're going to lend based on such a high quality collateral. When the banks will judge the collateral by the weakest link. So once I bring real estate into the picture as using that as collateral, now the potential rates that I'm going to get on borrowing are going to be higher. So I would rather leave that link out. And there's tricks that we can use to circumvent it. Usually what I would do in that scenario that was just said, I would go to a different bank and I would say, could you write me a letter of credit, which will be backed up by that real estate? They'll charge me 1.5% or so for the letter of credit. And as long as it's a highly rated bank. And now that letter of credit I would use as the additional collateral, because that letter of credit is like a cash collateral. And once again, the lending banks judge by the weakest link. So it would be a shame to lower my level of collateral and add on 50 basis points to the loan, it makes a big difference in the long term.
Sure.
That might have been a little deep for everybody.
Yeah. Oh, I mean, I'm following it.
No, you got it.
There. So, and part of the reason on the interest and the component inside the policy, for those unfamiliar, is interest inside life insurance accumulates tax free. So getting an extra half a point inside is more valuable than maybe paying a little bit more on the outside. And so you want to have as much compounded tax-free growth inside the life insurance policy. And so what Mel's describing here is, as you're stacking the performance, the balance of the cash in the policy is growing. There's a loan against it. And then at some point, maybe 10 or 15 years out, you're able to mature and, let's say, what's the word I want? Retire. You can retire the loan where the policy is now the bank loan. You've taken away all that security and everybody that's in the mix. You've fulfilled the obligation of the premium financing. They're getting their money back. And now the policy's unencumbered and somewhat paid up is a term people will use. So it's just a matter of where in that window, the corridor, you're able to achieve that. And then the premium finance people are making their spread and the bank's getting, some of their money. And ultimately, the WIFM, what's in it for me as the person doing it is, I really didn't put out the millions and millions of dollars every year in premiums, as the term goes, OPM, right? Other people's money. I'm letting, that's what it's all about. I'm letting other people's money, instead of me taking $2 million out of my cash flow and my deal flow for whatever I'm the speed and velocity of money, I'm letting the borrowing side take care of it for me so that I keep, again, let's just say it takes 10 years to fund it. So a $2 million premium, $20 million, you didn't lay out. You allowed other people's money to go into the mix. You maybe had, in Mel's case, he's even stacking the loan interest where you're not paying into it. And so at the end of it, somewhere in that calculation, Mel's going to show you where the loan is then retired, fully serviced, paid back, and enough cash value remains that the policy is paid up. Mm-hmm. A pretty head-on summary.
That's
there.
Pretty good. You got it. It's pretty good.
All right.
Once again, obviously, we don't know what the performance of the markets are going to be and the interest rates are going to be, so we can't pinpoint exactly, when that point of paying back. And once again, it's not that there's no risk, but I would call it low risk, not no risk. When set up properly, it's not free, but it's low cost because you're not taking the money out of your pocket. You're just putting you're putting that collateral. You're clogging up the collateral.
And if I may, let me elaborate further in the strategy. So Mel referenced 50 million. So let's just say the death benefit initially is the 50 million that the client or the family needs. The loan and the valuation in there adds into the death benefit to cover the loan, so that based on the corridor and the loan's growth and valuation inside it, it's always to net the person buying it their 50 million. So the death benefit may go up to 70 million if there's a $20 million loan inside of it. So the death benefit's 70 million, but the family's going to get the 50. When the loan is eventually retired, the death benefit settles back down to the 50 and remains, again, depending on how you design the policy, right? Because they may want some inflation growth and they could add to, have it
usually
above. But
usually when we're talking about a younger client, somebody, for me, younger is like in the 40s. Actually, I have done some high net worth 30-year-olds, but when they're in the younger age, if you go at the death benefit, to 90 at life expectancy, the numbers are going to actually usually end up being $200 million.
Right.
But once again, it looks a lot more oppressive today than it's going to look in 50 years. Those type of numbers.
It's time value of money and the compounding effects, and then
compounding is crazy for people that don't realize it and don't feel it. The brilliance of compounding. I imagine you discussed it on your show before.
Yeah. No, it's I call it the camel humps. How many camel humps, your money doubling and accelerating, how many times can you get your money to double? And that's the best way to describe. So there's two tiers you mentioned to me. that I want to break down, because there's the affluence of the high net worth individual that has high estate taxation exposure, where they could and need to use something like this for consideration and get with their estate planning attorneys and their advisors on this. And then the second one you talked about was high income earners using a strategy like this. So I think a lot of what we just touched on was more maybe on the high net worth side, but we could overlay a little bit of that, right? But where would this go? Because this is something I'm less familiar with on the high income earner side of how they can leverage and use their premium financing. So why don't you break that down for us?
Okay, sure. Let's do it. So this is actually something that's very exciting. This is a little bit of a world-changing type of idea, in my opinion. So this concept of premium finance is something that it's always been one of those ways that the rich get richer, so to speak. It's just a brilliant strategy, and the rich people seem to make so much money off other people's money and doing so well with it. And I can't say it's a no-brainer, but for the right, you know what? I'll tell you like this. If all the facts line up, then it's a no-brainer using premium financing. Now, there was a concept developed by a company that I work very closely with, NIW. Nowadays, there's plenty of copycats of this concept as well. That the idea is for high earners. We're talking about people that make 200,000, 300,000, 400,000 a year and up, who are able to put away, at least $25,000 a year for a minimum of 5 years into a type of retirement plan type idea. Now, the way that it works is that it's not as complex as the ultra high net worth premium finance that I discussed before. Rather, the way that it works is for every dollar that somebody is going to put into this plan, a lender is going to put in 3. So you put in 25% of the money, the lender puts in 75% of the money.
25 grand by them is going to get them $100,000 deposit. 75 is going to come from the lender.
Yeah, I'm going to structure it a little different. I'll explain that in a minute. The way that's actually going to be done is, let's say it's a 10-year plan that requires $50,000 a year. So the first 5 years, the insured will split it with the lender. The insured puts in 25, the lender puts in 25 for the first 5 years. And years 6 through 10, the lender is going to put in the full 50. So we're going to end up in this example, there's $500,000 being invested on your behalf. Once again, it's not a favor, it's being borrowed by you. And you only put $125,000 out of pocket. And now, if you just think very simple, basic arithmetic, assuming that it's true, which we have to discuss, that this type of policy will always, over any 15-year period historically and economically, we have good reason to assume this will continue into the future. But any 15-year period historically, once again, the concept of this type of policy wasn't necessarily around, but we have the historical data to know how it would have performed historically. So when you plug it in, it's always had a spread of at least 2%, the growth of this policy versus the cost of the money. All the numbers are readily available, even if the product wasn't. So think about it like this. If I'm going to earn $7,000, and a lot of people, if you think about it in real estate, a lot of people have an easier time, visualizing real estate. You could buy $1 million building, right? If you have $1 million in your pocket, $1 million cash, you have 2 options. Buy $1 million building. In this market, the cap rate, we'll just call it the rental return, is 7%. So you can make $70,000 a year, 7% return on your $1 million. That's one option. Your next option is go to that same market, put down $1 million, and have a bank give you a mortgage of $3 million. Now you got a $4 million building. Now, let's say you had a rate, I know the rates are a little higher now, let's say you had a rate of 5%, just to pick a nice round number. So how much are you going to, and forget about growth, let's just do rental. I don't want to make it more complex than it needs to be. So then you're going to have how much rental return per year? And that's $70,000. It's a $4 million building. So you're going to have $280,000 rental return. But you have to service your loan. You borrowed $3 million at 5%, right? So that's $150,000 of servicing. So 280 minus 150 gives you a net return of $130,000. So instead of a $70,000 return, you have a $130,000 return. And instead of 7%, you have 13%. Right, that was accomplished just by using leverage. Now, don't get me wrong, you're not going to net 13%. There's fees, there's cost of insurance, etc. I don't want to mislead anybody. You're not making 13%. But you're positioning yourself to make a very, very nice return, net cash by doing this. And the idea of life insurance and using it for retirement planning is that one of the advantages is you're able to have your money compound and grow without getting affected by taxes. It's tax deferred, and you could access the growth with policy loans, which will make that a tax-free way of accessing the growth.
So when you're doing the high income premium financing, are you using it as a withdrawal for the cash later mechanism, or are you doing it for a less expensive way to get and finance their actual death benefits? Or is it just a combination?
I would say it depends. It very much depends on the client. And by the way, they'd be structured a little bit differently depending on the case, depending on what they want. I would say somewhere between 80 to 90% of my clients are interested in retirement income. Of that world.
They're designing it to create a tax-free income stream later, which I've done plenty of those over the years. I've just never structured it with a financing mechanism. It wasn't in my realm of, the brokerage firms weren't getting into that. They were just pretty much, doing big policies with the cash flow. And then so what we're talking about here with Mel is you're in essence overfunding a life insurance policy to get the tax-free growth to then create later a tax-free income stream along the lines loosely in comparison of what a Roth account might have created for an investor, but a Roth has limits on contributions. So in Mel,
most of my clients can't even contribute.
They don't qualify. So you'd have to convert, a plan and pay the tax and then convert it to a Roth. So yeah, there's limitations in the Roth contribution world. There's based on insurability, and I'll put that as a preface, there's not a lot of limitations on funding the insurance. So you just have to qualify, you have to be healthy, you have to have insurable interest. But what we've done in our space, Mel and I, is you have people who are self-employed, doctors, accountants, attorneys, and then small business owners, and they have the extra cash flow, and then they create their own retirement plan. It's not subject to ERISA. It's not a 401k. It's using life insurance, which, by the way, they need for their family and liquidity anyway. And then they're overfunding the life insurance, building up the cash value, and then structuring the removal of that cash value over time in retirement. So when the spigot of work stops, or they're ready to take it out, and then they create a tax-free income stream. And a lot of times it's 2, 3, 4x of what they put in that they ultimately pull back out. And the way Mel and I design it is it's totally tax-free income. And oh, by the way, the life insurance remains throughout their mortal existence to keep it intact. And also ultimately the net proceeds do get paid out. And so that's right. So that's the design. So the twist you're doing or have done is you're able to create that same concept, but using more leverage in the financing side than you could do. So I got to go back to my people and say, how come we're not showing this?
And if you think about it, I'm going to just make a very simple point, which when people hear this, they're like, wait a second, that really makes a lot of sense.
Sure.
There's two reasons why a life insurance, and I would say specifically an IUL, even though there are people out there that are doing this with whole life insurance, but personally, I prefer doing it with an IUL. But that is a a different discussion.
Yeah.
The reason why this works so well is because what's usually the risk of leverage? So when people think about leverage, they often think about a margin account and a brokerage account. Over there's a big risk. Let's say if somebody has, their money matched dollar for dollar in a brokerage account. If their account goes down 50%, what happens? Margin call, and you have zero. You lose everything.
Let me just set this up again. I'm going to break this down for the listener. You're opening up a new subtopic in here. So what Mel's referring to is when you have a stock brokerage account, you've got assets in stocks or mutual funds, maybe even bonds, you can buy on what's called margin. And so the margin is we're going to lend you an equal amount against the capital there. So if you have $100,000 in the account, you can borrow and buy $200,000 worth of stock, 50-50 ratio. Okay, so that's Mel's setup. What Mel's now saying is if the account drops a certain amount of money, in this case 50%, well, it just wiped out the equity that the client put in. And now they're still liable for the 50% of the loan. And that's where when you see Wall Street melting down in various cycles and crashes, is people are getting margin calls. And by the way, the margin calls come in a lot faster than losing 50%. They'll start coming in at 25%. So once the account starts dropping 15, 20%, they're going to be asked to pledge and put up more capital to reduce the loan and reduce the exposure. But if something, what happened in 87 is people got blindsided and clobbered and that equity got wiped out. So I'm sorry for the tangent here, Mel, but you opened the door. I want to make sure that people just don't assume what the heck margin is and the talk. So I cut you off a little bit. So you're basically saying if somebody had 50-50 leverage and they lost half, which is a risk that they would have exposed, they're actually removing all of their equity. There's nothing left.
So as much as I love leverage generally in finance, not specifically, in certain areas, for example, as we just discussed, Bruce just said so elegantly, when investing in the market, there's some serious risk attached to using that margin. In using margin, using leverage, borrowed money to invest in a life insurance policy is by definition way, way safer. Why? It is true that I cannot guarantee growth. And I don't know what exactly the market's going to do in any specific year. But it's never going to go down outside of fees and costs or whatever. You're never going to drop 30% in 1 year. That just can't happen. And therefore, since that can't happen, there's never going to be a wild margin call scenario that's going to blindside you like in 87. It just can't happen. And therefore, the leverage that's used to invest into life insurance is by definition much, much safer than some of the other type of investments.
Earlier, you mentioned, we could have elaborated a little bit. You said, you brought up whole life and then you said IUL. So IUL stands for Indexed Universal Life. Indexed is going to give you participation on the upside to a variety of indexes, depending on what's available. But let's just use the most common one would be the S&P 500. So if the S&P 500 has a historical rate of return of 10%, you're pegging your performance to that index, usually prorated. You don't get full-blown 100% participation, but you get an incremental amount of the participation. And what Mel's saying is the key to this ingredient is no downside. So people use indexed annuities, they use indexed life insurance to get upside participation, but guarantee no downside risk of principal and loss. Now you have fees to deal with along the way, but depending on 1, 2, 3%, whatever the fees are, again, it depends on the product. It's life insurance. You're going to have costs of insurance, so you could say that's a fee in and of itself. You still have to pay for the insurance. So if the account made zero performance in a bad market, you're going to still have to pay for the insurance. It could
be down a little bit, but you're never going to get a 30% loss in the year.
You're not going to see $100,000 become 70 and get a phone call saying you got to put in more money. So
exactly.
But you can have flat performance. You're just not going to have negative dramatic negative performance. So that's some of the secret sauce.
That's the big risk of the leverage, is the dramatic negative performance.
Right. You're taking that piece off the table. So it's other people's money. It's playing the spreads. The way you design this, what usually gives our clients more upside is the IUL strategy historically, because it's giving you equity performance without equity downside. And then when you leverage that 2 or 3x with the financing, you're picking up an extra couple of points along the way. And thus the account's growing a little bit faster, a little bit meatier.
Usually it's going to give you around 80 to 90% of the upside of the market. At the end of the day, if we look on the long term, money in the IUL versus money in the market, I know there's a lot of people in my industry that are scared to say the truth, but I could say that that actual dollar put in 1929 into the IUL, which didn't exist yet, or put it into the market, you would have done better in the market on average.
Sure.
That doesn't, but it's not the same risk component. No. Using that same argument,
and not the same tax, not the same tax component either.
Correct. Exactly.
You're going to pay taxes on the normal equity investment. You're not going to pay taxes here. So it definitely has some twists. So let me summarize a little bit, and then if there's any pieces I missed, jump in on it. So we're talking about using premium financing basically in 2 different types of strategies: a high net worth individual that's looking for large sums of proceeds using the life insurance to create liquidity at normally demise so that the estate can be settled. They might have millions of dollars of real estate, family-owned businesses, things that they're not necessarily looking to get rid of or liquidate. They want their children, their grandchildren, their heirs to continue to own the real estate. You got waterfront property and in Southern California, and you don't want to give it up. You own half of Manhattan. You own a big company, family-run and owned company. You want it to stay in the family. Well, Uncle Sam's knocking on the door saying, "Hey, Mel, you owe us $100 million. How you paying it?" And so families over the years have lost those businesses without proper planning. Ergo, where the plan man is, we're talking about planning now for the more high net worth, maybe even you want to say the term ultra high net worth. And so jumping on this, is there a certain level that you would say what would categorize high net worth? Like, where do you see that sweet spot? I'm hoping they're lilistening, but if they know people that are, like, is it 50 million above, 100 million above? Is it
so
bigger?
We're talking about young guys, like 30s or whatever. Anybody who's worth $15 million should start thinking about this. If they're in their 30s, if they're already in their 50s or 60s, so you should need. If you have $25 million, you should start thinking about this.
Okay, fair enough, and it's a good point. And again, why? Because compounding of money. If a 30-year-old's got 15 million, that could be worth hundreds of millions, right? And then somebody who's maybe senior, already made their money, they're at the back. They're on the back nine, if you will. And they've got 40, 50, 100 million. They're going to potentially sell a business, whatever it is. They need something of high liquidity purposes to generate. Then they need to use this and structure it. And again, let's be clear, you need to leverage this using your estate planning attorneys. There's structure that has to go on there using trust work. So it's not that clean and simple when you're dealing with the estate planning.
We were always. I do not set up the trust. I'm always on the phone with the estate attorney and telling him exactly what I think, my personal way of how I prefer it. Right. But at the end of the day, it's his decision, not my decision.
Mel and I know. Mel and I know enough to be dangerous, but we're not practicing lawyers. We kind of know the terminologies and the structures because we've done it for 100 years. But you need the attorney to do it and dot the I and cross the T and sign off on it. So always keep that in mind. You need to bring in your estate planning attorney. Now, on the high income earners, that doesn't necessarily require the attorney side necessarily at the early stages. Again, depends on their situation, depends on the size of their assets and their policies, but that may not require normally. Would you agree needing estate planning?
Normally it does not need. Most people does not need. It's very, very often that clients say, "Do you mind running this by my accountant?" And I'm always very happy to do it. I really actually enjoy running it by the accountants. a little secret.
Then they tell all their other clients.
Exactly. For
That's
me,
right.
it's great.
Let me have your accountant's
I love
number,
those
by the way.
accountants.
Yeah. That's a loaded question for us, right? It's automatic door opening. So, and in that regard, why it wouldn't necessarily go into the trust side is because the client's looking to take the income out. So if you're putting it into an estate planning style trust, well, it's not really right. They can't really get at that money. So it
we
wouldn't
will
be
generally,
structured
by the way,
same.
house it in a revocable,
Right.
Nevada-based trust or something like that. That gives some extra protection for the client in case he ever gets sued or whatever. But
Right.
usually most of my clients are going to want an irrevocable trust where they're able to access those funds for retirement or whatever, as opposed to the high net worth people who they want in an irrevocable trust, which the positive is it stays out of their taxable estate, but the negative side of it is they can't access that cash.
Right. It's usually a one-way
unless they have
transaction.
good attorneys.
Mel, it's been great to get to speak with you on this. How can people reach you if they want either more information or have questions? We always tell them they can come through me, but we want to give a shout out to how people can reach you, and then we're going to put it in the show notes.
Okay, sounds great. So yeah, you could reach me. You could send me an email at mel@finance premiums. That's MEL at financed, FINANCED premiums, PREMIUMS.com. Or you could try to call me. I can't promise I'll pick up. 347-619-2999.
Awesome. Thank you so much. So again, folks, this has been another episode of Ask the Planman. Today we were speaking about the differences in premium financing, how people can take advantage of the tax codes, leverage using life insurance and lending to boost their estate planning coverages, their tax-free income needs, basically a 401k-esque style on steroids, if you will, using life insurance and cash value accumulation, which, by the way, is tax-free. So our guest today has been Mel Lieber are you in Tel Aviv or Jerusalem? Where are you physically?
Jerusalem. But, I'm often in New York.
Well, today he's joining us from the promised land of Jerusalem, so we appreciate him. It's about 11 p.m. out there his time when we're recording this, so I appreciate you being with us so late in your day. Folks, if you need some advice, always get it right. Come Ask the Planman. Please like, share, subscribe. Go to planman.tv for our YouTube. Go to asktheplanman.com for all our previous episodes. Until next time, again, when you need some advice, always get it right. Come Ask the Planman. I'm your host, Bruce Weinstein. Mel, thank you so much for being with us today.
Thank you so much for having me, Bruce. It was a pleasure.